Hello, this is Carlos Asilis from Glovista Investments, here to share market outlook for the week of July the 26th. First, a brief recap on this past week's major macro and market developments. At the macro level, the ongoing rotation of economic activity momentum leadership away from the US into the rest of the world continues to hold. For example, a number of economic releases out of the US that underwhelmed consensus estimates include the July US NAHB, the June US building permits, weekly jobless claims, June Chicago Fed National Activity Index, and June US existing home sales. Conversely, a number of activity releases out of the rest of the world beat consensus estimates, including June Taiwan industrial production, June Taiwan exports and imports data, June Japan exports and imports data, and as well as July French manufacturing confidence levels and July German Markit manufacturing level. In the policy domain, this past week was also friendly to markets, particularly via the dovish commentary that emanated from an important strategic guidance update meeting out of the ECB. The contents of that meeting and the narrative that came out of it was unambiguously dovish via the reset to higher levels of the inflation rate levels at which a financial tightening is likely to occur. Moving on to the market performance domain this past week, we witnessed a very volatile week, as we had been discussing this past week. On Monday, for example, the Dow Industrials recorded its worst daily decline of the year, only to recover very strongly in the balance of the week. And this held true across a number of other equity indices. The S&P 500 recorded close to a 2% rise for the week, led by growth stocks rising by close to 3%. IFE, International Developed Equities, rose 20 basis points, and emerging market equities lagged, declining 2%, led or fueled primarily by Chinese equities that underperformed, primarily on account of a recent spike in regulatory concerns. Emerging market equities, excluding China, were approximately flat for the week. In terms of the macro financial variables, such as the treasury yields and crude prices, they were approximately unchanged. As we look ahead, our investment thesis remains unchanged. We expect the fading of adverse seasonality conditions, positioning backdrop, and to provide additional support for global equity indices to move higher. We continue to favor value-oriented sectors and stocks led by U.S. financials, energy materials, as well as industrials, emerging market equities, and a number of select high-quality secular growth stocks out of the U.S. This coming week, the macro calendar is relatively light. We witness a number of diffusion sentiment indicators out of the manufacturing area in the U.S., such as the July Dallas Fed manufacturing. We also have the June U.S. durable goods orders, the June U.S. new home sales, July German IFO survey, July Richmond Fed manufacturing, as well as the June U.S. personal income and expenditure report that includes the core PCE report, which will attract a lot of attention out of investors. Importantly as well, we have the FOMC, an important FOMC meeting for this week. That's it on our end. Thank you for your time and good luck this week.